Welcome to our webinar. Before we start with introductions, I want to share some of our resources available on AIinsight.com that may help you during COVID-19, as well as for the upcoming Reg BI compliance date. We recently held a Reg BI webinar, which is available on our website. If you want to earn CE credits for watching, log on to AI Insight and find it under CE Courses menu. You could also register for upcoming alternative investment-related webinars or access past replays. We've not only included AI Insight webinars, but also those from our industry partners. Our latest episode of the Alts Insights podcast also covers alternative investment trends, including COVID-19 impacts. I'd like to start by introducing Mike Kell, Senior Vice President of Program Management and Business Development. Mike?
Hey, Jen, thank you very much, and certainly appreciate everybody dialing in, to listen to our webinar today. We have a substantial response. I'll do a quick kudos to Taylor, who I'll do a formal introduction here in a couple of minutes. But I really owe it to Taylor for calling both me and Kevin Gannon at Stanger and saying, look, it's upsetting the fact that we're not able to hit the conference circuit this spring. Who knows what's going to happen this fall? But this is still, even at the conferences, it's one of the highly, one of the panels that has the most attendance. So it's certainly something that we want to continue to do. So thanks, Tyler, for the idea. We're glad that we see in the registrations and everybody jumping on right now that even sitting at your house with your dogs and your children and everything else going on, you're still able to join. So we appreciate that. Today we'll cover data from year-end 2019 and actually Q1 2020. And then, I think what we're going to do, the three of us will commit to doing this going forward as well on each quarter, updated data until the conferences come back around. And hopefully we're together this fall and can do it in person. But if not, we want to continue to provide this content, so we'll do so. I'm sure most of you are aware, each of us, it's the same people that typically do it at the conference. I'm Mike Kell with AI Insight. I will cover private placements, excluding 1031s. Taylor Garrett with Managing Director of Mountain Dell, he'll cover the 1031s. And then Kevin Gannon, Chairman and CEO of Robert A. Stanger and Company, will cover the public non-traded side of things. A little bit of a teaser, I purposely put Kevin at the end. Kevin, as all of you know, is a very interesting gentleman with some wonderful, great stories and very welcoming to all of us to his annual gathering. A little bit of a shift this year, as everybody could imagine, with things going on. And we promised that we would be able to touch on that and give an update to everybody of exactly what I mean by that. If you've never listened to Kevin, then you're certainly in for a treat. But Kevin will actually hold that story until the very end as nothing more than an enticement for everybody to stay on the call. It's likely that we might go a little bit over. We'll try to respect your time. If you do have a hard stop after the hour or at the hour, we are recording this. We will send it out to those of you that are on, as well as anyone that wasn't able to attend, as well as the deck as well. So if you want the information, we'll send out the file and we'll send out the recording. But again, we appreciate your time. The other point is it's very obvious. Each of our firms, we have a substantial amount of information. What we're going to share with you right now is really just scratching the surface. So I can't encourage everybody on the call enough to reach out to us. All three of us, our firms, this is what we do. This is what we love to do. We love to have conversations about this. So if we don't report something you have interest in, let us know. If we have it, we'll share it. If we don't have it, we'll try to get it and be able to share it with not just you, but the rest of the industry as well. So certainly lean on us for that. Before I get started with the actual data, many of you on the line are subscribers to the AI Insight platform, which we greatly appreciate. I just want to point out where you can find this type of information within the AI Insight platform. Most of you are aware from the dashboard, you just select a program. This is new, the streamlined review process makes it very easy for anyone to access all of the information specific to any investment program on our platform. You can see circled in red here is the industry report. If you're looking at a REIT that happens to be on the screen here, you click the industry report, it's going to pull up the most recent industry report specific to REIT. Same thing if you were looking at a private placement. The other place you can find it is reports and logs, icon at the top, come down, financial performance reporting, and you can see industry reports circle there, as well as a lot of the other features. And again, same thing with Mountain Dell, same thing with Robert A. Stanger. They have a lot of other information that they're happy to share with you. So with no further ado, I'll jump in overall private placements. I think, I'll kind of jump around a little bit and again, talk about year-end 2019, how things closed out, as well as Q1 2020. I think it's important to note, to kind of set the stage for the discussion, the fact that obviously with COVID going on, we're not sure what's going to happen in the future. We can talk about what we've seen in Q1. It'll be interesting to see how things look in Q2. We do notice that certainly in the public markets, we're seeing some offerings suspend their redemptions, suspend their offerings, either suspend or lower their distributions. A lot of those things are going on in the public side. Not as much of it in the private side, especially suspension of offerings, but it is happening. So that's something that we're watching. Q1 was still healthy. You can see here on the screen, it's just kind of a layout. This, if you look at like the month to date, it's for March 2020. Year to date, obviously, would be through the end of Q1. But so we had a great first quarter. We had 48 private placements added to the platform, new coverage, which is a 30% year-over-year increase. And then something at AI Insight that we focus on, certainly we have capital raise information, the platform, and I'll touch on that. But something else that's important to understand is the target raise. So 48 private placements with a $2.4 billion target raise, which really should be what these particular managers are seeing as an opportunity in the marketplace for whatever particular structure or asset class or strategy their focus is. So, and that $2.4 billion is a 36% year-over-year increase. The one thing that I'll touch on is obviously last day of April. We see where our numbers are in April right now. We are on average with last year. So even year to date through April, we're still going to be up pretty substantially. We'll still be around that 30% mark. But May and June, it's really going we're already seeing some of the sponsors that ultimately, maybe they were going to come out in April. They had a particular offering ready to go, but they're going to hold off. We have seen 4 of them actually take the offerings down and said, look, we're going to wait this out. Those are typically the ones that they didn't have any selling agreements yet. And it was just, that's what they wanted to do. But we are starting to see some of them push it back. So they didn't come to market yet. We assumed it was going to happen in April. Now they're saying, hey, maybe May, maybe June. As you can imagine, we'll kind of see how that goes over time. But it depends on the nature of the economy and when things come back or how quickly. Year-end 2019, we had a record year in 2019. Very excited about that. We initiated new coverage on 200 private placements. It actually was a round number. We do have some restricted deals. If you add them in there, maybe a little bit less than a 10% increase over that 200. But that was still 18% year over year, and we had a record year the year before. And then $9.5 billion target raise for those new private placements that we added to the AI Insight platform, which is only a 1% increase year over year. So ultimately what that tells you, if we had 80% increase in the number of private placements and a 1% increase in the target raise, you're ultimately having more private placements, but each of them are for a lesser target raise. And you can see the breakdown here. I'll touch on that as I go through some of the slides. This is kind of an interesting chart. So if you're looking at each of the individual time periods, it's really the net change in open offerings at the end of that period. So in 18, you could see we had a substantial jump from year-end 2018 to year-end 2019. And ultimately, that means that obviously 12/31 of 18, you have a lot of programs closed, or 12/31 of every year. But what you're ultimately seeing with this trend, with just the orange bars here, ultimately, or columns, is that more and more offerings are open. and it's, you can't say for a longer period of time, but ultimately you have more offerings coming to market and carrying over to the following year. And you're seeing that, we've seen that trend for quite some time. We expect it to keep going forward. But Q1, you can see ultimately at the end of Q1, we had 178 private placements open, raising capital with $17.6 billion in target raise and $8.8 billion in capital raise. So those 178 private placements that were open at the end of Q1 2020 in our platform, open raising capital, they had $17.6 billion of their target, and they had raised $8.8 billion towards that $17.6 billion target, which of course is slightly up from year-end 2019. Again, at year-end 2019, we had 172 private placements, just over $16 billion in target and just under $8 billion in capital raise. And to put that year-end 2019 number into a little bit of context, we had that huge jump in 2018 to 2019 with total number of open programs, and then a slight jump from year-end 2019 to Q1, but that's with 158 private placements closed in 2019, and it raised 85% of their target. As you could imagine, you look at like a 1031 deal where they historically raise 100% of their target. And then there's some other larger deals you could imagine, a $2 billion private deal, maybe they only raise $750 million, and that's a big difference. But 158 closed, but we're still net increasing year over year, period over period. So it's a very healthy marketplace from what we're seeing. Now I'll go a little bit into certain categories. So we'll start with opportunity zones. As you can imagine, I don't have a nice chart for this one quite yet, because really last year was the first year that we've seen opportunity zone funds come to market. So instead, I figured I would talk a little bit more about some of the specifics. So if we look at Q1, so what you'll see kind of here, there's four main bullet points. The top two are going to be where were we at the end of Q1 2020, new coverage. So that means how many new funds did we add to the platform? And then Q1 2020 current coverage. So that's, okay, combining that with all the other funds that are still open raising capital, what does that look like? So in Q1 2020, we added 7 new opportunity zone funds, which is 133% year over year, because as you could imagine, Q1 2019, there wasn't a lot. Everybody was still trying to search for the guidelines, what's going on, what can we do, what can't we do, et cetera. But of those 7 funds, it equates to $772 million in target raise, which is, again, up year over year. Okay, so what does that mean at the end of Q1? How many total funds were in the marketplace on the AI Insight platform, sold by the bulk of subscribers that are on the platform? 21 total funds, $3.3 billion target raise, and they had raised just under $1 billion within those 21 funds. The sectors vary substantially, as you could imagine. You have certain, it may be a very pointed hospitality, just a one hospitality program that's raising $10 million, to a very broad blind pool, right? Just generally speaking, we're going to do all these types of great things, but not identifying a particular asset. And those, they ultimately range on a low end, 6.4 million, the larger one, 500 million. And we actually have an energy focus. All of them are real estate, so we don't have any that are focused on businesses per se yet. But we do have an energy focused fund. U.S. Energy came out with an opportunity zone fund last year. That's still on the platform raising capital. And that's certainly the outlier, because the rest of them are really real estate focused. We have had some that raised that have closed out. And of those that closed out, they raised 100% of their target, and they were on the market on average 212 days. Year-end 2019, we had 18 funds we added to the platform for $2.39 billion target raise. And then at the end of 2019, we had 15 funds remaining, and you could see just under $2 billion target raise and $670 million in capital raise. Real estate, so again, non-1031, Tyler is going to cover 1031 exchanges in just a minute, but real estate non-1031, this is kind of interesting because we see some decreases, especially in 2019, but as you could imagine, what happened are the opportunity zone funds really took away anything that was going to go into the non-1031 real estate. Went into the opportunity zone fund. So if you added the real estate non-1031 category to the opportunity zone fund category, you probably get a truer picture when you're comparing year over year. But for the sake of this here, it excludes opportunity zone. So Q1, we had 9 funds, which was down 10% year over year with a $640 million target raise, which happens to be up 10% year over year. So larger target raise per fund added. At the end of Q1, so ultimately we had 54 real estate non-1031 offerings in the platform, raising capital, $6.1 billion target with $1.5 billion already committed to those funds. And then 2019, ultimately we added 41 total, which was a 5% decrease from 2018. But again, if you were to add in the opportunity zone funds, we were a substantial net increase over the prior year. Then again, $2.36 billion target raise. Energy, obviously we see what's going on in the energy markets. I can't stress enough the fund managers that are out there, the sponsors that have these energy deals, lean on them, call them. They want to talk to you, whether you're an advisor, a broker-dealer, RIA, et cetera. They want to talk to you. They want to help you through this with your clients, whatever they can do to help. I can't stress enough to lean on them. You can see here, obviously, energy in general has decreased over every period. We started seeing a little bit of an increase from 17 to 19. But Q1, we added 1 fund so far, which is on par with last year, but it's a small deal. So from a target raise perspective, it's only $10 million. At the end of Q1, we did have 6 total funds on the platform, $275 million target, just under $50 million in raise. Comparison, so 2019, for the entire year of 2019, we did add 10 funds, which was 11% increase in just under $650 million target raise. Conservation contributions, a big 0 so far. This is nothing new. We're very familiar with this. Really, these are those tax deals for the most part that come out in Q3 and Q4. It'll be interesting to see what we see this year on the conservation side of things. But in 2019, you could see we had a little bit of a down year in 2019. 23 funds, which is down 12%, and then $243 million target, which is down 12%. We're all aware that there's some IRS focus on the conservation contributions, which kind of brought those down a little bit. But I think that's still working itself out. We've heard, depending on who you speak with, I think overarching opinion is the fact that the outcome should be more favorable than not. So we're hoping that that's the case, and it's the best thing for the end client. They're structured appropriately, and they provide a great thing for the environment as well as the client. And if that's the case, we expect the business to be very successful in Q3 and Q4, and we certainly look forward to putting that to bed as well. Preferred securities, again, to stress, these are private preferreds. We obviously seen a big increase in 2017. Important to note that public, we have a number of public preferred, which are the majority of the ones out there that are raising capital. Still some great private preferreds as well. You can see here we added 2 new private preferreds in Q1, which is a 100% increase year over year with a $116 million target. And then, when we close out the quarter, we had 6 total private preferreds on the platform. I think we have another 5 or 6 on the public side of things. But $450 million target raise with 121 in the ground already. Not in the ground, obviously not real estate, but in the fund itself. For 2019, we only added 3 funds, which was down from the prior year, and so was the target of 130 million, which is down 50% from year over year. Last but not least, private equity debt. We have a big outlier here, so I'll touch on the numbers and I'll talk about the outlier. So Q1 2020, we added 2 new funds, which was flat year over year, but the target raise was up 20%. We at the end of Q1, we had 12 active private equity or debt funds in the platform, 4 billion target raise, and 3.5 billion already committed. The outlier here is Owl Rock, substantial institutional firm, great manager on the platform, and ultimately it's a very large fund, and they have a substantial amount of investor capital committed, both already in as well as I believe they have a significant amount of dry powder, which is kind of the story in the private equity and debt realm right now, really trying to capitalize on the opportunities that present itself with the COVID situation. 2019, we did add six funds, which was a 20% year over year. It was really small though, those funds that we added, 110 million total target raise, which was down substantially year over year. But again, I just really scratched the surface of the information. We do the private placement industry report on a monthly basis. So even though we're talking about reporting this quarterly on a call like this with everybody else, remember this information is on the platform. It gets updated monthly, much more granular information on the platform. So I certainly encourage you to take a look at that. But with no further ado, I'm going to hand it over to Teller Garrett, counterparts here at Mountain Dell. We appreciate them. Again, I think we all thank Teller for the opportunity of this webinar and those going forward. So Teller, the floor is yours.
Great, thanks, Mike. I appreciate it, and I appreciate the information that you presented there. If you will go to the first slide. The 1031 market has been unique over the last little bit. I would say since kind of COVID really hit. Our first quarter through April 4th was just over $1 billion in capital raise. So just simple math would throw us kind of 4.1 billion. Is just what we were projecting this year would potentially be, maybe a little bit more because of some of the full cycle activity that was starting to happen. We'll go and get into this more, but looking at where we were at last year, about 3.5 billion, 171 different programs that were completed with 38 sponsors doing that equity. Moving to today, $1.40 billion, 90 different programs that have been out or raised some equity this year with 34 different sponsors. If you move to the next slide, this just lays it out a little bit. And what I want to point out here a little bit, I'm not sure where the world's going to be. My crystal ball is as hazy as anybody's these days. But if you kind of look at 2006 to 2008, you saw some pretty significant decrease in equity that was raised. I remember kind of the end of 2007, early 2008, there was still some good equity moving. And then the second half of 2008 was very slow. And then we dropped significantly down to that 200 million kind of mark for 3 or 4 years, and then started bumping up from there. I don't anticipate it going to that, but we'll get into that a little bit more. But I like showing these numbers because it shows a little bit more specifically and granular than the graph before. So go to the next slide, Mike. So this was the 2019 numbers, and I've done a couple presentations on this, so some of you may have seen it, but it's good to see where we're at. Last year, the first kind of half of the year started out a little bit slower. The second half of the year picked up significantly. A lot of that was probably due to some full cycle activity that was significant, over $1 billion in DSTs that were done, 5, 6, 3, 7 years before, and had positive liquidity events. And investors, a large majority of those investors rolled back into another DST, oftentimes with the same sponsor, sometimes diversifying with other groups. If there were investors that went that had passed away, their inheritance may be cashed out, or people cashed out a portion of that. But we saw throughout the year growth. We went from, in April, I was projecting 6.5% increase. By the end of the year, we were at 40% increase, or almost $1 billion of increase from the beginning of the year to the end of the year of what we saw. Yields we saw, they decreased over a few years, kind of got to that 5.5%, 5.6% in 2018 and 19. So not a huge decrease from there, but we kind of got to, I guess, the nadir of where we saw average yields. 41 states, so most states are getting DST activity. I'll show you a map in a few slides that will show you where all the activity is. There's definitely some states that saw more activities than others. And our average equity, over the year, we added less equity than we raised. So we started the year with a certain amount. On average, we were raising about 5.4 million per month more than we're actually adding to the market. I mean, really what we saw is sponsors couldn't come out with deals fast enough. There's a lot of demand for a product like this for investors that are, you know, maybe aging a bit and want to sell their fourplex or their rental house and get to a more passive income style. You know, these programs have definitely seen a tremendous amount of increase in interest from those investors. So I think we'll continue to see that as a percentage of 1031 investors have that interest. And then average deal size obviously increased a lot from back in the TIC space. They increased a lot from 2018 to 2019. And I'll talk a little bit later on why I think that's probably going to change. So Mike, if you'll go to the next slide. This shows all the sponsors that have raised money so far through the first quarter of 2020. These are the 34 sponsors that have raised some portion of equity or have a deal live on the market. We've seen a little bit of change at the top, but for the most part, you have the same core group that's been there for, you know, quite a bit of time. JLL's obviously moved up pretty quickly as a new, you know, institutional sponsor entering the space. And Carter Exchange has started to come out with some deals. So different groups that, you know, more institutional people that have experience in other type of assets or raising money in the retail or institutional channel continue to enter the space and are looking for other activity. We've had other conversations with bigger groups that are also looking to enter that may or may not based on where we're at today, but I think over time we'll show some pretty strong interest in that. Go to the next slide. So this is the sales by asset type. So equity that's actually been raised this year, this is the equity where it's come into. As always, we've seen a very strong multifamily kind of slant to what's happening, but it's come down a little bit. 62% between student housing and multifamily done in that first quarter. Retail, which, you know, is heavily triple net type of programs, net lease, single tenant, or a pool of net lease single tenant properties being aggregated together, has definitely seen some interest, definitely had some success, and probably going to have more success moving forward. You know, talking to some of the big players in that space recently, it seems like, you know, if they're necessity-based retail, they're probably having some pretty good success at having collections. You know, apartments, I think a lot of the discussion right now between sponsors and broker dealers and reps and investors are collections, how much collection is going to come in. You know, for the most part, I think we're kind of seeing 80s to 90s. There's things like on apartments, you know, the jury's out on Class A versus Class B. I think we've seen, at least so far, the first month where it was tested, probably Class A maybe had a little bit better collections, but there could be movement there. It just depends where the economy goes. I think, you know, student housing, I'm trying to have some discussions there. I think people are curious about what that's going to look like next year, and people that have already signed leases for the 2020, 2021 school year, and parental guarantees, and our college is going to be opened up. So it's probably a pretty big question mark. 55 plus, age restricted, you know, where tenants maybe aren't working. I think those have seen quite a bit of success from the deals we've seen at collections where they're not as geared towards what's happening in the economy and you know, not necessarily having jobs that they're working at, more retired. So we're seeing self-storage seems to be having a lot of success, a lot of interest in the marketplace, raising a pretty good rate, you know, whether it's college students moving home and needing a place to store their things, or people moving in with parents, as well as, you know, been somewhat recession resilient in that regard from what we can tell and what we're seeing. Hospitality has been 8.4%. I think that's safe to say that's probably going to significantly decline in the near future. And I think senior housing, you know, lower leverage senior housing has probably seen some pretty good success in the marketplace. Obviously, some questions on the COVID, but I think as you get through that, these people for the most part have to be there, and memory care at different places. So pretty solid. But the rest of it, I think it just kind of depends on whether they're single tenant, whether they're multi-tenant, and where the economy is going to go and the success moving forward between office or multi-tenant retail or industrial. Energy obviously is going through a unique time right now. You know, probably going to be a time that I tell my kids about when futures were negative. Still hard to wrap my head around it, but I'm not an oil expert. So we'll see how much money they raise in the 1031 space versus, you know, more traditional capital raises outside of 1031s. All right, the next slide, Mike. So this says the same thing, just looking at very granular dollars and cents. So of 1.04 billion, we just got the last report out where we raised about 110 million in the last 2-week period. So now we're about 1.15 billion of equity raised so far this year through April 17th. The numbers didn't change much, right? Multifamily has still been a big part of that. Student housing hasn't raised a lot recently, but you know, other asset types that we're starting to see a lot more success in are more contractual type of cash flows that are happening, or people that aren't as geared as tightly to the economy and where we're at. Next slide. So this is the states. This is where we're seeing a lot of deals. Illinois has seen a big increase. We're used to seeing stuff that's kind of down in the Sun Belt states, I guess you'd say, more in California, which is a bit unique. Texas and Florida have always been pretty strong states, tax-free states that we've seen a lot of deal flow in. Seems like Georgia is still continuing to get a lot of demand there. Carolinas have always been pretty sought after type of communities. So depending on the markets and what's happening around them, this is where we see, you know, population growth or areas that have a very specific use for the asset type that's being sold. Have continued to have a lot of success in those states. And then you have a lot of states where it's kind of getting jumped around. We don't see a lot in the Dakotas, don't see a lot in Montana. We usually do see properties in Colorado. I haven't seen any there. Utah, you know, Vegas is getting hit a little bit, obviously with the strip being closed down. My cousin sent a picture of them riding their bikes down the strip with not one person on there, but the Bellagio fountains were still going. So that's good. They were still in full use. But this is where I think we'll continue to see a lot of the state activity is going to be in these southern states. Next slide, Mike. So this is what's available currently today. Obviously, we see hospitality went down to 0. Energy is a small part of that. Multifamily has increased. Deals have come out in multifamily, and other sectors have kind of decreased. Retail, we'll talk about again a little bit later, where CMBS financing is all but gone, is my understanding. I'm not a capital markets expert on the debt side, but talking to some of these, you know, titans in the industry, it seems like CMBS is going to be pretty hard to come by in the near future, especially for DST type of programs. Maybe we'll see it in July, probably more like August or September. So if, you know, retail deals or other deals are going to be happening, it's going to be with friendly banks, regional banks, life companies, you know, balance sheet type of lenders, not CMBS. So with that, you'll probably see smaller size deals that are happening that can happen on those balance sheets. You know, as I talk to some of those groups that are bringing out those kind of deals, it's, hey, we've had a relationship with this bank. We've done it for a long time. So they're going to continue to lend to us because they know us, they trust us. Or it's, hey, this regional bank, their max lending capacity is going to be, you know, 20 million, 30 million. Those are going to be the debt size deals, as opposed to some of these larger deals that are 50 or 60 or 80 or 100 million type of CMBS deals that we've seen in the past. Those are not going to exist for a while. And I'm not sure when they're going to come back. And as I talk to some of these sponsors, I'm not sure if they know, but I think there's kind of looking forward to probably August is a realistic time frame to be able to get financing through CMBS, do the same size deals they were doing in the past, and bring those out. Next slide. So this is where we're at today. And I say today, meaning April 3rd, of where after the first quarter, this is what the deal flow looked like. These were the percentages. So we had 620 million of equity available on April 3rd from the programs of equity that had not closed. 5.43% is the average annualized returns, 56 offerings, 24 sponsors that have deals in the marketplace today live, ready to have equity put in them. Percentage of equity available, you saw in the chart before, it's 68% of its multifamily. Student housing is still a big number. Percentage of equity raised in 2019 is 46%. And then the percentage of raised equity you see in that third column decreased a little bit on multifamily, decreased a little bit on student housing. Retail's popping up a little bit. Medical office medical has come down significantly. I think through the first couple of months, everything was pretty solid there. I think now that, doctors and some doctors, not hospitals, but doctor offices or dentist offices or whatever those are currently maybe closed. And so maybe that's a reason why we haven't seen as much activity there. I'm not sure. Office, self-storage has decreased a little bit. Industrial, senior housing's come up quite a bit. We didn't see as much senior housing last year. My understanding is a lot of these are low leverage or zero leverage on a lot of those deals. Obviously, we saw hospitality increase significantly. I think that number is going to drop. I think that number is probably going to stay where it's been at all year for the rest of the year from where we're at. Maybe it comes back. Going to the next slide, Mike. All right, so market summary as of April 3rd, 2020, this is the equity raise, number of sponsors that have done those deals. Looking at 506B versus 506C, that's getting to be more and more of a discussion these days. There's thoughts on lessening that or I guess increasing the 506C. There's been discussions with a few groups and in the industry trying to maybe rally around 506C a little bit more for, contemplation issues or different things that allow for more flexibility in that, especially today as no one's traveling to go to meet with clients or get out there and network with clients. There's different advertising or marketing that's being done. There's webinars, virtual webinars and seminars that are being done today. In my opinion, I think we're going to see a pretty significant increase on 506C programs moving forward for that purpose. But I think there'll be more discussion at a DISA level or regulatory level to try to see if broker dealers and sponsors get more comfortable with that. But my opinion is that's going to increase pretty significantly in the near future. As it's always been, mostly DST type of programs, more of the TIC programs are kind of one-off, or not the major groups, or kind of small, not small offerings, but a small group, maybe 2 or 3 investors, 5 investors that are doing deals with maybe moving parts, or larger exchanges where that's typically happening. Days on market, average days 203, the median's 137. I candidly think we're going to see that number increase pretty significantly after July 15th. All right, the next slide. All right, so this is, I called quite a few people in the industry, try to get opinions on where we're at, where we're going. I think everyone's kind of throwing their hands up in the air. I had a comment earlier today. I can't even project what my own numbers are going to be, let alone what the industry is going to be. But so give me some leeway, give me some flexibility here to kind of be casual about this and what feedback I'm getting. It's not I'm not a prognosticator. I don't know where the world's going to go from here, but I can tell you what smarter people than me think and what kind of information they're giving me and try to give you a summary of that. 2019, we raised $3.5 billion. That's $9.6 million a day. Through the first quarter, we were more like 10.2, 10.3 million of equity a day that was getting raised. So we had an increase. Things were looking great. Growth was 40%. 1031 interest. In my experience in working with the clients that we have at Orchard Securities and seeing what else was happening out there, we actually saw an increase in early March and March. And we had investors that had a 1031, they're already in their 45 days, they were getting ready, they wanted to put their money to work in good solid programs, coupled with someone that was trying to do a deal themselves and was trying to get financing. That financing dried up in a hurry, right? So that's always a great thing about DSTs. Financing's already in place. You have a structured product for you that you're able to come come to, you know what the leverage is, you know what the numbers are. And so we saw, you know, almost an uptick in our activity, and it showed, right? In early March, the equity raised was 200 million, which is a big number. That was a big 2-week period of reporting that we did on our Mountain Dell report. Then the July 15th extension happened, and I think I speak for all of my colleagues, maybe not everyone, but a lot of the people I've talked to, that kind of put everything on pause for a little bit of time. And investors are like, hey, I'm going to wait. Now instead of having to identify by April 15th, I can wait till July 15th. And that gives me more opportunity to look at my options. And, you know, and I think there'll be some deals that come out or that are kind of post-COVID pricing. And as I talk to my sponsors and colleagues, I think, I don't think that's 100% accurate. I think, I don't think that these post-COVID pricing for good trophy assets are going to be available in the DST space, because I think the ability to do due diligence today is tough. You can't go look at the property. You can't fly there and go look at, feel and touch it and look through the units. The financing's unique. Even if you're doing Fannie Freddie type of financing, you know, deals that I have heard of closed or that I know that have closed, they've had to have, you know, 6 months of reserves just to pay the loan payments plus principal, right? So significant dollar amounts that you're reserving not to use on the property, but for just in case scenarios is what has happened in the last few weeks that I've heard of. And so that puts, you know, good for a DST on, and we're talking apartments, good for a DST that they have a lot of money reserved. That gives a lot of safety there. But it's also inefficient money and money that's being set aside. So I think the ability to go out, get Fannie, Freddie, CMBS financing, I don't think that there are going to be a lot of deals that come to market in the next few months. I think the good deals are going to have equity get raised pretty quickly. And so unfortunate for the investors that are waiting till July 15th, I think you're going to see a significant amount of deals close up. And the 640 million of equity that we have available today, I think is going to shrink. And, you know, maybe there's going to be some great deals on the market on July 15th. But I do think people that have deals out right now that feel some uncertainty are not going to be eager to come out with a deal very quickly, or may not have the ability to come out with the deal very quickly. And so I'm concerned, obviously, for reps or investors that, you know, I think a lot of that equity may go away. And so that'll be a unique time frame. But that July 15th thing on the surface was probably a positive thing, but I also think it could be a negative thing if everyone's chasing the equity that's available, and it might be less. Could be a unique situation for investors in the next couple of months. Groups like I said earlier, JLL and go back, Mike. Groups like JLL and Carter and other groups that are looking at space or have entered the space. I think we have seen some good groups that are entering. I like where we're at for a marketplace on the quality of groups that are entering the space. Continue to enter it. More broker dealers were entering the space. You know, some big groups, we see it in the news, are pulling all alternative agreements. I think that will, you know, hamper that activity and challenge the activity for all the programs we're talking about. Kevin, Mike, and I will be different, especially for some of these larger programs. If you don't have some of the bigger capital raising groups, you know, we'll challenge the ability to raise money. Even if there's 1031 interest there. RA involvement definitely continues to grow. We're seeing that firsthand. 506C, I discussed that. Currently 28% of the marketplace. I could see that going to 40, 50% maybe by the end of the year, but that's just a guess. Currently have 13.6 weeks of product available on the market. That came down a little bit with this new report. We just got finalized this morning, but still hovering a little bit higher than where we've seen. And then full cycle activity, DSTs, they were projected to be over $1 billion. I think that's going to be closer to 150 to 250 million. And I think we will see some, some people that may not go back into the DST space. So that's definitely going to hamper it. Some bullet points I don't have on here because I was gathering it over the last couple of days after I submitted it. Again, talking to some of the industry titans, I think right now, as of April 17th, we've raised 1.15 billion of equity in the market. On the low end, I've heard 1.175 billion for the market. So that's only 600 million more for the remaining 9 months of the year, which is low. On the high end, I'm hearing 2.5 billion. You know, my guess is right in the middle of that. As I've talked to people, I think it's going to be 2 to 2.25 billion. So you raise another $1 billion, that's, you know, 100 or so million every 2 weeks for the remaining 9 months. I think that's probably pretty accurate, but that's a guess. You know, we're not in an economy right now where there is money. There's a lot of money that's been printed, a lot of money. The banks after Dodd-Frank have been required to have a lot more money on hand. I don't think this is going to be a credit crisis like we had in 2008. This isn't a scenario where you have a willing buyer and a willing seller, but you just can't get the financing. I think that will move past after kind of that July or August timeframe. But, you know, we are in a unique situation where this isn't Adam Smith economics, and this is, you know, whatever, 2.0, 3.0 of economics, where the government's very involved in printing trillions of dollars and putting it into the economy. So we'll see if transactions continue to happen. I think the DST allows for a great avenue for passive investors to get into institutional quality real estate. And I don't think that's changed at all. And I think it's even improved, and good assets that can maintain cash flow and be a strong investment in this cycle. I still think there'll be 1031 volume happening. Couple other things. The secondary market, I'm involved with a company called Central Trade and Transfer, and for the first time, we may get 1 or 2 calls on people wanting secondary market transactions for DSTs. Now we're getting, you know, that many calls a week, and so we're starting to see a lot of more activity where people may want or need liquidity from a 1031 perspective. There is, you know, somewhat of a market there, but it's not a vibrant market. These are intended for long-term investments. So I think this will be a unique time where we'll see more and more of that in the industry, and different than ticks that were much more complicated to buy and sell on a secondary basis. I think there's a little bit more opportunity to do it with DSTs where it's less painful to do that. And then, you know, we talked about it. Financing is going to be tough for the foreseeable future. So we'll see. We'll see if people that do have 1031s, if they're able to do their own type of deals, or if they're going to be wanting to do DSTs because financing is already in place. Coupled with, we'll see if DST sponsors, how aggressive they are at bringing out new product. I think all the product that sponsors are going to bring out, these $100+ million deals, are probably not going to be happening in the near future. We're probably going to see the bigger deals be, you know, 40, 50 million, maybe smaller, maybe bigger. But I just think that average deal size will go down as sponsors try to, you know, navigate how much volume's getting done these days. So with that, we'll turn it over to the best storyteller in this industry, with Kevin Gannon.
Thanks, Taylor. Good to hear you guys. Great slides. And every time I hear your name, Taylor Garrett, I always expect the theme song from Hawaii Five-0 to come on. You know, isn't Taylor Garrett the guy on Hawaii Five-0? Any event, let's go through this. Go to the next slide, please. Keep going. So we're going to talk about the non-traded programs, the non-listed securities, NAV REITs. You know, how big are they? There's 11 deals out there that raised $23 billion so far, $4.9 billion in the first quarter alone, but dropped off to 627 in the month of March. So big drop off there. Some closed or suspended deals had raised $61 million, and now are just fairly de minimis. They've closed their offerings. Lifecycle REITs, the traditional REITs we all know and love, there's only 6 open deals out there that raised $138 million in the first quarter. I mean, in the month of March, 647 in the quarter, and $1.6 billion cumulatively for those funds. But the closed deal, there's 43 deals there that have $42 billion of capital in them cumulatively. So there's quite a bit of capital tied up in those lifecycle REITs, which over the next couple of years, we expect that money to get freed up by virtue of transactions, mergers, listings, whatever. Interval funds, a lot of money been raised in there over the years, almost $50 billion of equity in 62 funds, 742 in the month of March, $2.4 billion in the first quarter. So a runoff there in terms of fundraising. BDCs, $1.3 billion in open deals, $46 million in the month of March, $176 in the quarter, but there's $15 billion of additional money in closed deals there. So all in, there's $133 billion in NAV REITs, Lifecycle REITs, interval funds, and BDCs. That money all, for the most part, will get freed up. The NAV REITs are perpetual, obviously, but the other REITs, all that money should get freed up over the next couple of years. So that's an exciting prospect for our space to figure out what to do with that money as it becomes available. Next slide, please. In terms of actions, we've been tracking something called non-traded REIT and NAV REIT Actions. What's been going on in this space? There's 13 deals out there, as I mentioned a few minutes ago. They raised $2.4 billion in January, $2.5 billion in February, $781 last month. So quite a bit of a runoff. A lot of that's Blackstone. Blackstone, their fundraising declined pretty precipitously during the month of March. But cumulatively, those guys have raised $23 billion between all the entities. A couple of guys have suspended their offerings or reduced or suspended their dividends or their DRIP plans. In the case of the Griffin program, the Griffin did it in anticipation of a strategic alternative transaction prior to COVID-19. So it was really just the one endpoint deal that had any what we call REIT actions that you want to be watching unfold. So we thought it was the industry was pretty dynamic, and kind of the right thing happened that you would expect to happen in this space. We took the foot off the gas in March, right? We had the foot on the gas in January and February. We took the foot off and only raised $781 million in March. So we thought that was a good reaction, general reaction by the space. There were a lot of things going on, obviously, by firms, but we think that level of fundraising kind of shows there's some intelligent life out there. Next slide, please. On the Lifecycle REITs, so we only have 10 deals that are open out there, raised 227, 313, 147 in the last 3 months. So again, took the foot off the gas. A couple of those guys suspended their offerings. 4 of them suspended their offerings. 2 suspended their dividend. 3 suspended their DRIP, and 4 suspended their share repurchase program. If you flip to the closed deals, where there's almost $42 billion of equity in 38 deals, 17 suspended their dividend, 2 reduced their dividend, 20 suspended their DRIP, and 31 suspended their share repurchase program, and 2 of them deferred the announcement of their next NAV. All of that, again, intelligent moves, I think. Right now, I know investors don't like it. Maybe the FAs don't like it. But when you need to hold on to your cash, you got to hold on to your cash, right? So suspending the dividend, suspending the share repurchase program, those are smart moves. You can always reinstate them, but locking up that cash or keeping that cash inside the company is a good move in times like this. We think as the market rolls out of this, they'll loosen that up, release the dividends, and move forward rather quickly once this pandemic subsides, and we think it's subsiding already, right? Next page, please. Here's the performance trend. This is, to me, the most amazing chart we've ever produced, right? And what it kind of shows you, if you can look through the detail, we'll be glad to share with you some additional detail. We published a thing called the IPA Stanger Monitor, and what that is, it tracks the performance of all NAV REITs and Lifecycle REITs and BDCs, and compares it to kind of what's going on in the public market sector. And what you found in the public market, monstrous overreaction to the pandemic, monstrous overreaction. If you look at the peak to trough from 12/31 to the trough, which was around the 3rd week of March, the value of the underlying real estate in a traded REIT declined 27%, and the REITs themselves, their equity value declined almost 40%, and that is just knee-jerk reaction, crazy overreaction to what's going on in the marketplace. Since then, it softened up a little bit. From 12/31 to today, real estate values, the gross real estate value is down about 15%, and the percentage change in the equity value of traded REITs is down about 26%. So we've seen right now it's about overall across the entire REIT spectrum, it's down about 120 basis points. I'm sorry, the cap rates are up about equivalent of about 120 basis points today. We think that's still an overreaction. That's an overreaction to what's going on here. So what are we seeing? What does that tell us? It tells us that the traded REIT market will tend to overreact on the upside. You'll be overpaying on the upside, and you'll be hurt further on the downside. And the way that has bounced around the last couple of weeks, just looking at these lines, those lines that go low there, that produce a -9% return for the last 3 years. -9% for the last 3 years from the traded REIT market. That's pretty bad versus the alternatives, the NAV REITs, are up over that same 3-year period, about 17%. The Lifecycle REITs up about 12%. Again, more calm. Now, you might argue that, well, maybe they didn't mark their NAV to market as frequently as they should have. Well, the NAV REITs are marked to market as of the end of March anyway, and the Lifecycle REITs are marked, once a year, so they maybe haven't borne the full brunt of it. But we don't think that the publicly traded REIT market reaction to what this pandemic is all about is rational. It's completely irrational. It's anywhere, and it depends on the asset class, but it's anywhere from, right now it's averaging about 120 basis points, and it's been over 200 basis points in the last 30 days. To me, big overreaction. I think that the alternative investment products are way more rational, way more logical, and let's not forget there's great underpinnings in those assets. In the traded REIT world, what do you have? You have publicly reported financial information, you have analyst estimates, and you have intelligent people who invest their money, presumably. And in the non-traded space, you have all those same intelligent people, but you also have an underpinning of real estate appraisals, right? There's nowhere else on the planet do we invest institutional money or even retail money other than the traded REIT market without an underpinning of appraisals. We like that. We think that's intelligent. We think that's smart. We think when this is all over, the alternative space ought to get a big uplift out of this. And as people look at how volatile the returns they were getting in the public market during that pandemic, which was probably, and by any reference point, way overstated. So we think this chart kind of demonstrates that, and it's something to really keenly follow over the next couple of quarters. Next slide, please. These are the performers listed in order. Last 3 years, annualized return, how they've done. That's a running list there, but you can see it's done pretty well. The traded REIT, the Morgan Stanley U.S. REIT Index, is a -3%. So that's an annual return. So for the 3-year period, it's 9%. But all these guys they're performing, right? We like the way they look. The NAV REITs are giving us results we like to see. We expect, looks kind of like the Net Creep Index, the institutional index that we all kind of look towards. Next slide, please. These are the traditional non-traded REITs. If you look at some of them had some crazy, ridiculous, great performance over the last 3 years. So we think that that's good. These are 3-year annualized returns, meaning this is the annual return on average for 3 years. So you had some home runs hit by some of these various entities. So we like that a lot. We think that's a good result, and we expect to see more of that going forward. You're going to probably see it more in the NAV REIT world than in the traditional Lifecycle REIT, but we think returns from real estate, we think and expect them to be pretty good. Next slide, please. Fundraising the last couple of years, you guys know we peaked out in 13 at $19.6 billion. Last year we did $11.8 billion of fundraising. A lot of that's Blackstone. Next slide, please. Quarterly bottomed out in the third quarter of 17. It's been up every quarter since. 34% up this quarter, mainly the first 2 months of the year, not the third month. Next slide, please. Of top fundraisers, Blackstone, Black Creek, Starwood, LaSalle, Hines, FS, Nuveen, Inland, SmartStop, and CIM. That's 98% of the money in the first quarter. 73% of that is Blackstone. Blackstone had some monster months in January and February. They had a good year in each of those months. And we'll see where that levels off to. going forward, but still some healthy capital being raised even through March. Next slide, please. Here's kind of what we're seeing. Fundraising for the last couple of years. Last year we did 11.8. We're saying about 12 billion. A month or two ago we had predicted it could be as high as 20 billion, but we ratcheted off of that. We think it's going to be more like $700–800 million a month for the next several months as this thing unfolds. So that's what to be on the lookout for. We're very bullish about raising money for REIT securities over in the alternative space over the next couple of years. Next slide. That's it. Let me tell you a little bit. I know at the beginning of this, Mike asked me a little bit about, or mentioned my family St. Patrick's Day party. Everybody's always asked me about that. So let me finish with a brief excerpt about that. This year, my brother and I bought 350 pounds of corned beef, a couple hundred pounds of potatoes and cabbage. We bought 60 boxes of Girl Scout cookies, 30 boxes of Malamars, and we hired 20 Irish step dancers, 2 pipe bands, and an Irish band to entertain our friends and family in Boonton, New Jersey. It was going to be on the 14th of March. On the 13th of March, my brother and I spoke at 6 a.m. as they were about to light the stoves up, and we canceled it. When I called my brother, it was like canceling Christmas. He cried, and we said, we got to cancel it. So we took all that food. We didn't cook it. We took it all, and we had the people that came to help us prepare it. We had them all deliver it to a homeless shelter, and we delivered all that food to a homeless shelter. They have a couple months worth of corned beef, I think, and Girl Scout cookies. And a couple days later, we realized we actually, for the first time in the history of the Irish ethnic group, we actually did something smart. We did something smart and something we felt good about. So what did we decide to do about it? So what we decided to do is that next year on the 13th of March, which will be when we would traditionally hold it, we're going to cook up 350 pounds of corned beef, a couple hundred pounds of potatoes and cabbage, buy all the Girl Scout cookies and Malamars, hired the 2 pipe bands and the Irish band and the Irish step dancers, and we're going to celebrate our 54th and our 55th St. Patrick's Day party at the Sokol Hall in Boonton, New Jersey. You were all invited. You were all invited. And this coming year, there'll be one difference. We're going to open up the bar. The bar will be free. When my father died on his deathbed, he made me and my brother promise we would never open that bar because all the cops and firemen can't handle free beer. So since my father's been dead about 27 years, he doesn't have a say in this anymore. We're going to do it. We're going to open it up. So free beer next year, and be on the lookout for a good celebration. And we got a lot to celebrate getting through this pandemic. So my best to all of you. Thank you.
Thanks so much, Kevin. Yes, and we will all be attending the party next year. Just a reminder to the audience that this webinar was recorded. We will send out the recording tomorrow. We'll also send out everyone's information, so if you have any questions, you can respond then. I'd like to say a special thank you to Stanger and Mountain Dell for partnering with AI Insight to deliver this call, and also thank you to the audience for calling in. If you have any questions, please reach out to AI Insight Customer Care Team, and have a great afternoon. Thank you.